Well, I would say this is your friendly warning to crypto holders, right? Why? Why do I need to give you a warning? Well, if you've been listening to what I just said earlier, well, then you'd know, right? You would be aware of the risks and rewards coming up, and you would know not to make that mistake. By the way, if you're just now joining me on this stream, hello and welcome back. And I wanted to let you know, real quick, in summary, what I've just been talking about with the folks listening on the stream. So, yes, it is Memorial Day 2024 in the US. So that's late May, right? What is it? The 20-something of May. And why does that matter? Well, because tomorrow, when the traditional markets open back up, you can and should expect to see something very particular happen across the traditional markets and the crypto markets as well. And what is it that you're going to expect to see? Well, if you trade the VEPs, what you can expect is you can expect there to be movement, volatility, and entropy. Why do I say that? Well, because that's what happens, right? That's what happens all the time. On traditional markets, it happens when they're open, and especially after a long weekend, you will tend to have some pretty nice movements, especially if there was any kind of decent movement during the period of time since the market was closed. So all those traders are ready to get back into gear, rearing to go. Oh, they were away from the desk for 3 days. Now they got to get back at it, play catch up, or get ahead of the ball, or whatever. Now, crypto traders, the degens who've been at it nonstop, even if they took time off, they still had the option to get into the market and trade, because of course the market doesn't close. So they, if they haven't been at their desks, and have been missing out in their heads on possible trades. It trades 24/7. You're not missing out on anything, as long as you understand how trading works. Right? So what is the warning? Well, the warning, again, is that there's going to be movement. But Yasha, there's always movement. That's right, there's always movement. So it's a warning that you can take with a grain of salt, because there's always movement. It's nothing to lose your mind over. Right? Unlike all these other shillers who will tell you, panic, jump on board before you miss it, or get off the train before it crushes you. That's not how low time frame traders actually trade, if they're serious professionals. Serious professional low time frame traders see every single day and every single trade is just another day and just another trade. And they're not going to waste their time, right, chasing for, the one big move. That's absolute nonsense. That's a waste of time. It's a waste of finance. Don't do it. It's not worth your funds. Right? Bottom line, if you really want to actually trade low time frames, what you need to do is use the leading information that actually moves the markets. Why? Why would you want to use the information that actually moves the markets and not draw triangles or chart art? Well, because the answer is in the question, right? The actual companies that actually move the markets use that leading information. Why wouldn't you, if it's available? And if you don't understand that it's available, well, then you haven't been paying attention to what I'm telling you, right? I'm one of the co-founders of Alpha Trading, and Alpha Trading is a tiny little community of VEPS traders. Why are we tiny community? Because most people are degenerate gamblers, and they don't actually want to learn how to do this. Why do you think you don't know anybody who is an actual trader at any of the high-frequency trading firms or quant shops that build algos for them, where they also do some trading? Right? Why do you think that is? Maybe you do know somebody. And ask yourself this: if you do know somebody that does that, do they often sit around and tell you how to do this? Do they show you the inner workings of how to use volatility, entropy, probability, and statistics to trade? If they do, you've hit the jackpot. Right? You have access to some of the greatest minds in the field. And bully for you. You can probably run some very nice trades if they've given you access to their bots and their tools and everything else. But if, like the other 99.999999999% of the planet, you don't have access to such fancy bots and tools as they've built for many hundreds of millions or billions of dollars over the years, and that are staffed by thousands of people around the world, well, then, guess what? It used to be, until not long ago, that you were SOL. And I don't mean Solana. Right? You were out of luck. Simply out of luck, to put it in a wholesome way. And it meant that you could not count on using traditional technical analysis tools to trading. Because if you did, you would statistically get wrecked. So what you want to do is you want to take advantage of the fact that at Alpha Trading, we have built tools that you can use, right, that you can actually use to trade volatility, entropy, probability, and statistics. And what that means is you can have a quantifiable, calculable, measurable, statistical advantage, mathematically relevant to actually trading. How do I know this? Well, because we built tools that use the exact same maths that these HFT firms use. They look at the rate of return, right? They look at the return of it on interest. They look at the mean of returns. They look at the standard deviation of returns, which is another word for volatility, or another phrase for volatility. They look at variance, which is the spread of data around the mean, which is another phrase for volatility. They look at entropy if they're in the top HFT firms. Most of them aren't. But the top ones know about it, and they use it. They know about normal distributions. They know about Laplace distribution. They know about all the different distribution levels that are relevant, right, for trading. And yeah, you can tell me, well, there's other distribution models. Yeah, thanks, we're aware. There's a reason that HFT firms run normal distribution models and Laplace distribution models. And they've only been using Laplace distribution models for like about 5 years at this point. And only the top ones at first, and now it's kind of more popular among them, but still, the majority of them at this point, probably implement Laplace distribution models. But it took a while for them to do that. But even if it's not, the overwhelming majority use normal distribution models still. And if you look at the distribution models, you'll notice something. They're constantly getting hit at various levels. like a standard deviation, 2 standard deviations, 3 standard deviations, right? Or the 68.3, the 95.5, the 99.7 with loss distribution models. Why do you think that is? Well, it's because they use bots, and they're humans, and there are humans who program those bots and manage those bots, and people like to do things simply. They're not super intelligent. They don't have to be super intelligent to be a great trader. They just have to be good at following programmatic rules, right? So the programmers make the bots to follow basically simple rules. As complicated as the maths are, they use simple rules to manage them. And the traders, they use relatively simple rules to make their trades, right? And really the trader at an HFT firm just makes sure that the computer is doing what it's supposed to do, right? And if there's a problem, then they intervene, right? This isn't like people who are running millions of trades per second are not manually running the millions of trades per second. They're just monitoring screens that are flying by with information, and they're looking at a little summary box in the corner of the screen that tells them, their P&L overall, and whether or not their trades are, going well or not. And if they're not, it pulls up the key information that's relevant, and they can decide what to do about it, right? A typical trader at a typical HFT firm, usually is walking into the office at whatever time in the morning, depending on their time zone, or whatever time of day, depending on their time zone, firing up their station, looking at their system, seeing everything, making sure it's all going well. If it is, in an insane kind of way, they will very often walk away from their desk, let the system keep running, and they'll go have lunch or play golf or do whatever they like to do, run errands, I don't know. Right? And they'll come back in the afternoon, check up on it again. As long as they haven't busted the bank and everything's chill, they just carry on monitoring that station for a little while and make sure that whatever reports they have to turn in are prepared, and that whatever plan they have for the next day is in place, and then they check out, right? And that's what they do, right? Now, are there some who are more active, sitting on their station for many hours a day? Yeah, of course there are, right? There's all kinds of different trading models, right? But if you're running an HFT model, where you would think intuitively you need to sit there and monitor the trades, well, you do, right? But you can't monitor millions of trades per second. I mean, you can't physically absorb millions of trades per second into your brain. All you can really absorb is a summary. And how are their bots making so many trades? Well, they're given significant sized bags to run trades on whatever assets they've been assigned to run trades on. So maybe you're on the Forex desk, maybe you're on the bonds desk, maybe you're on the crypto desk, whatever it might be. And they love volatility, so they love crypto. And don't think they don't. What do? Well, they enter the targets for entries and exits that they'd like to hit throughout the day, right? And they use the same information about returns, means, and everything else, volatility, entropy, whatever, to see whether or not the probabilities are that the assets are going to do what they want their trades to do. Now, arguably, they have terrible risk management in that sense. Because again, they don't sit there and stare at their screens all day long. Right? This isn't the 1980s where they're sitting there with a phone in each ear and they're buying and selling from different people manually. I'll buy, sell with the phone, like in all those movies or whatever you might have seen. They're usually sitting in quiet rooms, relatively quiet rooms, where the loudest thing going is the fan and the clicking of computers and people talking, usually amongst themselves. And sure, there's celebration when something big happens, bonuses are in or whatever. But generally speaking, the pressure is on for you to make money for these firms. But the way that they manage their risk is very different than if you're a retail trader. And it's a bad idea to walk from trade when you're a retail trader and you're putting more of a percentage of your portfolio on the line on any given trade than a trader at an HFT firm who obviously is monitoring their trades. Even when they're away from their desk, they have access to information via their phone and whatever, so they can see how they're doing even if they're away from their computer, and they can generally keep an eye on things, and they do. But that doesn't mean that they can run everything normally when they're away from their computer. So at best they can pull the stop and make it pause until they're back, right? That they can do in most cases. But a well-seasoned trader at one of these firms is capable of coming in for an hour or two in the morning, an hour or two in the afternoon, and that's it. And you might ask yourself again, well, that sounds very dangerous and risky. Why would anybody do that? Again, they have huge bags, and their trades, individual trades, are tiny compared to the size of their bags. Now, of course, their tiny trades are probably giant compared to your average retail trader, right? Who's running a small trade, or even a normal size trade. But if you're managing tens of millions or hundreds of millions of dollars as a junior or mid-level or even senior level trader, right? Even billions of dollars in some cases, right? Then, the size of your positions are literally capable of moving markets. And they do. I've said it many times. Right? They literally move markets with their bags. Right? It's not some secret or something. Right? That is their job. That's why they call them market makers, because they provide the liquidity for the market. Right? Not just because they run limit orders, right? But because they actually provide the liquidity for the market in large quantities. Yes, technically, retail traders who run limit orders are doing the same thing. And that's why, as a retail trader, you want to do that. There are a number of advantages to running limit orders. Right? Market orders are for what people call market takers, which means you want instant gratification. You want an instant fill on your order. You're willing to pay a premium for that instant gratification because you don't have patience and because you don't know what you're doing. So you're just like, get me in. Okay, I'll get you in. And then as soon as you jump in, boom, market goes against you. You're like, how? Why does this always happen to me? I put my money on the line, and as soon as I do, I'm in the red. Yeah, because first of all, you're running a market order, so you're running at a significant disadvantage. And you could tell me, but there are exchanges where you can run trades for 0% trading fees. Yeah, there's some crypto exchanges that let you do that from time to time. But you can't build a career on that because it's not forever. So you need to understand how limit orders work, right? So that way you don't get stuck when your favorite bucket shop says, no more free trades for market takers, right? And also market makers, you're also going to pay a fee, but market makers pay a lot less of a fee than market takers. Why? Because as a market maker, you're making the markets, and that's why you don't pay as high of a premium. You pay vastly less, usually close to zero, if not actually zero. There are other advantages to running limit orders and not market orders. I'll probably save all those for a separate video as a refresher for those who don't know. But there are significant advantages to running limit orders, right? And also to stacking legitimate orders ahead of time, not trying to run the books and faith them. Because if that is what you're doing, if you're manipulating the books, then you are going to run into some serious trouble. Certainly if you trade on trad markets where that's illegal. But even on crypto, you're going to run into problems because the actual exchange will limit your ability to run orders if you are doing that, right? If you're trying to run orders and constantly move your entry number so that you can run the price up and up and up in order for you to actually sell at the top, right? And you want the market to chase your buy order towards the top, and then you switch it from a buy to a sell or whatever, right? That's, even though technically speaking that is allowed in the crypto space for now because it's unregulated, the exchanges will still restrict your ability to do that, right? And even if you try to be smart about it and put your order $5,000 away from the entry on Bitcoin, for example, or $10,000 away, just so you have an order preloaded into the books, you can do that too, but you can't move it that far away from the entry. Some exchanges will let you do that temporarily until they figure out, oh, wait, we should fix that. And then they remove that ability. And they restrict you to placing entries within, a few $100 or $1,000 of the existing entry, of the existing market orders, right? If you look at their order book, you'll see it's not that deep in terms of how far the numbers are from the current action. And why is that? Well, because if you're using a centralized exchange, they control how people are using their markets. And they do work in cahoots with other exchanges to make sure that people can't just do what they want in terms of setting prices to wherever they want. Because in theory, if that was the case, well, you could buy a Satoshi, you could sell it 2 accounts, right? On one account, you're selling some Bitcoin, on the other one, you're buying. And you could just go, buy a Satoshi from one of your other accounts for $1. Okay? Not because of an ordinal or a rune, just market rate. On the market, pay $1 for a Satoshi. And then, any Bitcoin you have, and if you own a whole Bitcoin, will temporarily, at least, be worth $100 million. Why? Well, because there's 100 million Satoshis in every Bitcoin. So you could easily go do that. But they don't allow you to do that, right? You know why? Because that's not where the market rate is considered to be at the moment. Who determines that? Well, and technically speaking, it's whatever the buyers and sellers agree to. But if you actually did that, all right, let's say you actually managed to buy and sell a Satoshi between your 2 accounts for $1, and you could then say, well, I have 10 Bitcoin, therefore I have 10 times $100 million, I have $1 billion. Guess what? You're not going to get liquidity for it. Nobody's going to pay you that $1 billion if you sell them your 10 Bitcoins, right? It's not going to be any other buyers. So it's not the market rate. You can't sell, even if you and a friend did it, right? So it's not just yourself. If two actual people did this, said, okay, I'm going to sell you a Satoshi for $1, and your friend says, great, I'll do it. And then let's make billions of dollars selling our 10 or 20 or 30 or 100 Bitcoin. You can't, because there isn't money in the market that's available, because nobody will buy your whole Bitcoin for $1 billion or $100 million or whatever. You need to wait until the actual market has determined that that's the price, not just one player in the market, right? Yes, technically the market price is the latest market price, and technically if you ran an order that would do that, you could technically see, like on the 1 second chart, right, an order for $100 million Bitcoin, but that would be it, and it would just be that one Satoshi that was bought and sold for $1. It basically wouldn't register on any time frame, right? And it would get probably wiped out by the exchange, because they can do that. So anyway, that's a little bit of what I want to talk to you about today, is the warning, if you want to call it that there is always movement. And if you want to learn, like I said, how to trade with the leading information, to actually take advantage of real trades, and not just try to do the dumb things that the shills will, and the grifters will get you to do, to lose money on their affiliate links, right, by depositing onto their favorite exchanges, because they get paid a lot to promote those things to you. Well, then, like I said, just go on over to alphatradinghq.com/discord. Again, that's alphatradinghq.com/discord. And you too can learn how to trade volatility, probability, and statistics for free with freely available tools. You just have to request access to them. We'll give those tools to you, give you a chart, give you access to all the information you need to learn about it. Take as long as you like. We're not trying to sell you anything. We have an indicator package that is for professionals, but we really won't even let you buy it until you've actually learned how to trade volatility with the basic starter kit. For the very simple reason that, first of all, most people fail. And it takes us time to set up the pro trading tool. It's not some gimmick. And second of all, because if you don't know what you're doing with the starter kit, you're not a real trader, and you're not going to be able to handle trading with the real tools. The professional tools, I should say. The professional suite. Because the starter kit, they actually are professional tools, but it's just a very limited set to learn the basics. And if you want the advanced tools that have all the other fancy features that make trading a lot easier, you really need to prove yourself, and you do that by learning and asking questions, actually running trades. Once you've done that, then you are certainly welcome to try. After that, then you can decide if you want. If you're a real trader, you can decide to get the Pro Trader Tool package. Anyway, that's it for now. Happy trading.